Welcome to the podcast from Morningstar UK, the leading provider of investment news, views and analysis. This week, we're focusing on the potential US-China trade war and how politics have impacted the Asian markets. President Trump has revealed plans for trade tariffs targeting Chinese tech and innovation. But should investors be more wary of China's response? Emma Wall, Senior International Editor for Morningstar, speaks with Catherine Yeung, Investment Director at Fidelity, to find out more.
Hello, Catherine.
Hi, Emma.
So we've heard today, it has been reported today, that Trump is going to be imposing some trade tariffs on China. What do the reports say?
Well, nothing in terms of concrete at this point in time. So, in fact, year to date, we've had this a lot of headline news flow, but nothing tangible. And of course, for the rest of the year, we do expect to have this sort of toing and froing pattern between the two nations.
And there have been some reports to say that he's going to target the Made in China 2025 sectors. So that's automation, it's robotics. If that is true, it does feel quite pointed.
It does, because the Chinese are placing such an emphasis on these strategic sectors. And, I kid you not, most management teams across China, across a number of sectors, not just biotech or tech, for example, have been talking to us for the past 18 months, 2 years, about innovation and their innovation strategy. So it does feel, I agree with you, very, very targeted at what the Chinese themselves are targeting.
And of course, this isn't the first conversation I've had with an individual from an asset management company about the trade war between China and the US. But at the beginning of the year, it was the rhetoric from our side was very much, no one will let it go this far. They're too important to one another. But incrementally, we seem to be moving towards an all-out trade war, which could have quite devastating effects on the markets, couldn't it?
It could, but at the end of the day, whilst investors shouldn't shrug off this risk, you would hope to see some kind of negotiation. And in fact, let's say around Easter time, the percentage or the actual, if you had to say, put a probability on a full-blown trade war was probably about 20%. It's probably still around that level, maybe a little bit less, because if we look at what Trump did in terms of North Korea and Kim and that sort of toing and froing, you would hope we see another situation like this. But the really big risk, isn't it? It's pretty obvious what the US's stance has been year to date. But the risk is what the Chinese will do in terms of how they retaliate. And so if they increase tariffs, that's going to increase or push up input costs for Chinese companies, which then you could see them pass it on to the consumer, or it would just basically eat into their profits. And neither outcome is a good outcome.
And the US, this is not an individual stance on China. They've recently imposed tariffs on Canada or Mexico, talking about imposing tariffs on the EU. So as you say, we are quite clear about what the US's stance is, and it is protectionist. China, however, is not a minnow, is it? I mean, it is arguably as powerful as the US. So should we be more watching not what Trump does, but actually what Xi does when it comes to the impact that's going to be felt for investors?
Well, the risk is exactly that, what the Chinese will do. And again, if we look back at those original steel, aluminium tariffs that were announced, again, what was the true impact for Chinese companies? When we look at percentage of total exports, Chinese steel, it's only about 0.5% that gets shipped to the US, about 1.5 for aluminium. So again, it's not a material impact, but it's the association, the impact of sentiment or the market impact that we need to be mindful of.
Does it just mean that we should be prepared for a bit more volatility, not just in Asia, in this region, but across the world, which of course we haven't had in 2017 and preceding market cycle normalization, and this will just have to get used to it?
Well, exports, trade, from a Chinese perspective, that's the wild card. Geopolitics, that's the black swan, especially for this year.
So do you think we could see a correction this year, or is it just much more about sort of knuckling down and being brave?
It's about really looking for companies that have that sustainable earnings. Because when you think about it, Emma, even that correction we did see early in the year, January, February, it wasn't too meaningful, was it? And so you still get the sense that investors are a little bit complacent. Some people talk about the interest rate cycle being the key risk for the markets, but a lot of that is priced in unless, for example, one of the central banks really goes at a different pace to what the market's expecting. So, again, I would say that the geopolitical risk is really what's key. But again, because returns have been so sort of linear, nothing goes up in a straight line. So we do expect to see some volatility. And it goes back to the point just about looking for companies with that sustainable earnings.
Catherine, thank you very much.
Thanks, Emma.
A significant political event occurred this month when President Trump and North Korean leader Kim Jong-un met for the first time. But what does the agreement they signed mean for Asia's economy?
Hi, Rob.
Hello.
So it's been quite an eventful week for Asia. We've had the Trump-Kim summit, where there apparently was a promise to end nuclear threats between the two nations. However, if you looked at markets, you probably wouldn't be able to tell that such a seismic geopolitical event happened this week, could you?
No, exactly right. I think this week in particular is demonstrative of markets' behaviour. It's just moving on from one event to the next event, to the next event, to the next event. So you had the Trump-Kim summit. You've then moved quickly on to ECB, stepping back from QE. Next week there'll be something else happening for sure. So markets seem to take it in its stride, and immediately it's on to the next story.
Do you think that means that we've put the threat behind us? Or do you think this just means that actually markets have so much momentum at the moment, despite the sort of blip earlier in the year, that almost nothing will faze them?
Well, I think something like Trump-Kim, nuclear armament, disarmament, whatever you'd call it, is incredibly hard for investors to try and react to. How do you react to that? So they move on to stuff they can react to, stuff that's economically sensitive, stuff that's company earnings related. You focus on what you can understand, what you can forecast, rather than what you can't.
And I suppose then that next question is what can you forecast at the moment, and what does the sort of future of markets look like for Asia?
For Asia particularly, I think you're in a reasonably good place over here. I think when you look at markets globally, they are supported by a fairly benign macro environment. You've got pretty much synchronized global growth. You've got decent earnings growth. In Asia, where we are today, you've got relatively attractive valuations as well. So I think the environment today is supportive for equities, and it's supportive for Asian equities for all of those above reasons. Valuations, the micro and the macro.
Where does that mean that investors are finding value? You touched on the fact that emerging markets versus developed markets there look better value, but all markets moved up in 2017. It was quite an incredible year, as long as you were in the game. I don't think this year is going to end in the same way, is it?
I don't think so, possibly because the magnitude of the movements that we saw in 2017, it's hard to keep registering such sizable gains. I think the outlook for the markets is still, as I say earlier, still supportive. It is still positive.
And so then these macro events are not the thing perhaps that will get in investors' way for making gains. It will instead be fundamentals. It'll be company level stuff.
I think you have to separate to a degree the macro from the micro, and the macro effect in equity markets tends to do short-term moves. But over the longer term, what drives markets is not the prevailing economic tide, it's the corporate delivery year on, year out. And for that reason, we're positive on Asia. And to your earlier question about where is the value in Asia, I think it's definitely a North Asia trade rather than a South Asia trade, reflective of the valuation opportunity in markets such as Korea, Taiwan. In China, it's a very polarized market, but there are distinct pockets of value opportunities to be had.
And you're over in this part of the world talking to clients. What is it that people are worried about? If it's not stuff such as the Trump-Kim summit or Trump's trades tariff threats that he's been making this week as well, what is concerning investors that perhaps would cause a pullback?
Yeah, it's an interesting question, because if you were to go back a couple of months, trade tariffs were front and center of people's minds. Where you are and where the markets have been over, say, the last 5-6 weeks has been focused on rising rates in the US and the tightening of liquidity, the pulling back from QE in Europe. How does that impact emerging markets particularly? Because there's a view, tighter liquidity, bad news for emerging markets. And you've seen that play out in a number of markets, but it's those markets with current account deficits, and in truth it's played out mostly in the FX market. So today the concern is Fed policy, Fed tightening going to suck all of the liquidity out of emerging markets? It's a great question. I don't have a great answer to it, but I think, broadly speaking, tighter liquidity in the US is a reflection of strength in the US economy. Still the world's largest economy, That's very good for global growth. That's very supportive for top line in emerging markets.
Rob, thank you very much.
Thank you.
Our next guest, Schroders Jason Yu, says protectionism will increase market volatility, but the fundamentals remain strong for Asia equities, and so China shares won't be derailed by Trump's tariffs.
Hello, Jason.
Good morning.
So it's been a difficult start to the week for Asian equities. Trump has threatened even greater trade tariffs impacting us here in Asia. Do you think this is a bump in the road for Asian equities, or do you think this is the beginning of the unravelling of the great gains that we saw in 2017?
Yeah. Our view is that we believe there are a few reasons that lead us still to believe that fundamentally emerging markets are still very sound. The reason being that we still see long-term structurally positive benefits from emerging markets, including population, demographic dynamics, which is very, very favorable for emerging markets, as well as all the natural resources and land that emerging markets have compared to developed markets. So we do believe that while the trade policy rhetoric has spooked the market volatility, but overall we believe that fundamentals in emerging markets are still very sound.
How this geopolitical risk is not something that's new to this week, though, is it? It's something that you have been monitoring for some time and considering when making asset allocation decisions.
Yeah, Emma, you're absolutely right. So we've been monitoring a scenario which we call rise in the global protectionism since last year. The reason is because we started to observe that there are some tension in terms of the trade policies between the US as well as China, along with other countries as well. So from a multi-asset investing perspective, we do pay attention to those what we call dynamic forward-looking scenarios where we actually analyze the impact potentially to the global GDP as well as the impact on the inflation per se.
However, it must be very difficult to know with any certainty what the future holds, particularly in this tariff scenario. China may come back with some revenge tariffs. Trump could hit back again. So I suppose there's a little bit of kind of ignoring the noise. It must come in when making investment decisions.
Absolutely. As I mentioned, the rhetoric has definitely spooked the market volatility, but the truth is that none of us has the perfect insight into how the end game will transpire. I think that's just the truth. So what we can do is to continue to focus on our research on fundamentals, continue to monitor all the different themes that we have in the portfolio, continue to have a sense of all the different risks that might potentially impact emerging market growth and inflation, as well as the rhetoric and direction of travel between the trade policy negotiation between the US and China. These are all the important tasks and things that we do from multi-asset investing perspective.
I suppose it's also worth noting that if we were having this conversation in 2008, well, that was when the global recession was, but I mean 10, 20 years ago, it would have much bigger impact on China. China is increasingly reliant on itself for growth, both economic and indeed stock market growth, and the surrounding Asian countries. So while the US is one of the largest economies in the world, increasingly China is less reliant on it.
That's absolutely right. So when we look into the potential impact of this trade policy, what we call again the rise in global protectionism, the truth is that the impact for China as well as for US is quite limited compared to their overall aggregate GDP. But that rhetoric has definitely has impact onto the global sentiment on investments. And you're absolutely right, Emma, that China is not the China 10 years ago. So if we look at the allocation that we have in the emerging market portfolios, we do like China 8 shares given the potential of growth going forward for China's economy, as well as the recent inclusion of MSCI for China 8 shares to be part of the MSCI index. So we do continue to see very big growth potential for China. And China is definitely not the China 10 years ago.
Jason, thank you very much.
Thank you very much, Emma.
It is now easier than ever to invest in companies based in mainland China, and China is investing in global projects of its own. Our next guest, Rosen Janov, head of Asia for GAM, explains how China is opening its doors to global investors.
Hello, Rosen.
Hi, Emma.
So today we're going to talk about China and specifically the way that China is opening up to the rest of the world. One key signal of this was the inclusion of MSCI, the indexer including China A shares, so shares listed in mainland China, into its indices. How significant do you think that move is?
Well, it's not that significant because the weight of stocks that was included in the index is really minimal. After all 230-something stocks included at the end of August-September time, it will correspond to something like 75 basis points of the MSCI Emerging Market Index. But it is symbolic. It is a sign of China opening up. It is more of a marketing exercise on both sides, particularly considering the timing when it was done, end of June, before semi-annual rebalancing of various benchmarks. So it's symbolic, not huge yet, but it's a step in the right direction.
And as you say, it is symbolic because it's the latest in a slow wind of measures to help China become more accessible to international investors. There have been the stock connects between Hong Kong, Shenzhen and Hong Kong, Shanghai. How has that enabled investors such as yourself to access the Chinese equities?
Again, it's another step, great step in the right direction. It makes China more accessible. It makes it easier for foreign investors to invest onshore in China in Chinese A shares. Instead of having to go through various licensing exercises as before, which are lengthy and expensive, Stock Connect is an easy route to accessing Chinese investments for foreigners.
And there's a lot of rumours about there being a London Stock Connect or a New York Stock Connect. These seem a little pie in the sky at the moment, but is that something that we could expect in years to come?
Well, absolutely. I mean, China is opening up, China is liberalizing, China is becoming a greater player, more integrated into the global economy, into the family of markets, and it will make it more and more open. So possibly Stock Connect with London and New York will be the next step before China moves to open up its capital accounts and makes it really easy to invest onshore.
And what are the consequences of this? Do they create opportunities or do they create not so much problems but also challenges for fund managers?
Well, China is a huge economy. It's already the second largest in the world, and its market capitalization is just Shanghai and Shenzhen. The A shares market put together, it's greater than the entire capitalization of Europe. So it's a huge market which creates a lot of opportunities, but obviously a lot of threats. China is not just as portrayed by various politicians, a culprit that steals all global technology. China has started to innovate itself, has started to contribute technologically and in terms of new products. So it's becoming a bigger competitor globally.
And of course, it's not just about money coming into China, it's also about China taking its money and going global. Things such as the One Belt, One Road is a real indicator of the power that China has to improve the global economy.
Mm-hmm. Well, China has often used its financial resources to open up markets, to gain market share internationally in places like Africa, Central and Eastern Europe. And One Road, One Belt is symptomatic of that, using Chinese financial power, might, to open up businesses for its corporates, but also to gain some competitive advantage in these places.
And all of this sounds very positive, but unless you can access that and profit from that, it's not useful to UK investors, to international investors. So where are the opportunities that are created by all these measures making China more liberal?
Well, One Belt, One Road, to start with that, it's not easy to benefit for foreign investors because it's mostly Chinese private capital investing privately in these countries. However, over time, Chinese listed corporates are taking steps or inroads into these markets, and actually one can access opportunities there by investing in the same A shares, by selecting companies with good, strong Western-style corporate governance that already have made strong inroads into One Belt, One Road or have invested in Western markets.
Rosen, thank you very much.
Thank you, Emma.
Can China's stock market recover 20% losses? Chinese stocks are officially in a bear market, having lost 20% year to date. What has caused the slump, and will the market recover? We ask Andrew Swan, manager of the BlackRock Asia Fund.
Hi, Andrew.
Morning, Emma. How are you?
Very well, thank you. How are you?
Good, thanks.
Not as well as the markets, perhaps, because the markets have not been doing very well this year. Last week, I think we officially went into bear market in China, down 20%, and the currency's down as well. What's caused this downturn?
Yes, as you said, we started the year actually on a very strong footing, and not only have the early gains been given up, but we're actually now in negative territory for markets. And what's interesting is it's mostly sentiment that's driving the markets down at the moment, poor sentiment around future growth. Current fundamentals in the region, growth is actually still very robust, but the market is increasingly concerned about where growth will be going in the future due to the uncertainty that's been created by trade wars in particular, but also things like China's deleveraging process, the impact that may have on the economy.
If you look at China's growth, it's still a figure that would be pipe dreams to other parts of the world. But I suppose it's all relative to where they were before. You know, we're no longer in double-digit economic growth. And indeed, that's not something that the Chinese government have said that they're chasing either. So how much of it is sort of negative perception versus reality? Are we right to be concerned?
China has definitely entered a phase of higher quality growth rather than higher quantity of growth. That's been very explicit, and we're seeing that in the policies that are coming through. Higher quality growth can actually be very supportive for equity markets and corporate profitability. But the sentiment is very different to that right now, and it is very much that there's an expectation that if policy, particularly global trade, is implemented, trade wars, then you're going to see a fairly sharp downturn in growth. So while growth is good at the moment, the market is very worried about where future growth is due to the changing and uncertain policy environment.
I suppose a trade war, though, only really affects those sectors which are named by Donald Trump in this case as being targeted. How much does that then impact you as an equity investor targeting those sectors which perhaps are safe from Donald's grasps?
Well, it's, as I said, the measures announced so far are insignificant, really. There are some specific companies impacted, but the way the market is behaving right now is that it's going to escalate into something much bigger and with no end in sight. It's just a tit-for-tat type scenario where more and more sectors and more companies get impacted, because it's not just the first order effect, but there's also a second order effect. And I think what we've seen over the last decade or two is we are in a global economy where there are a lot of linkages, and therefore, you know, expectations that some economies may survive a downturn over others is not a good history of that so far. So there is risk that this does escalate, but I would argue that the markets where they are today, if you look at the various types of risk measures, are already pricing in a fairly significant downturn. In fact, the risk appetite measures that we look at would suggest that markets are fearing a downturn similar to 2015 or 2011 or even 2008. So investors are bracing themselves at the moment in their positioning in the markets. I still believe this will resolve itself, but investors seem to have a different view to that right now.
I suppose that leads me to my final question, is how do you invest with that kind of hope that this is perhaps a buying opportunity and actually fundamentals remain strong despite the concerns of the broader market?
Yeah, I think if you like to be contrarian at extremes, this is a great opportunity. And so that's what we're looking to do, is maybe move some of our outperforming positions into stocks which have been more impacted, where we think ultimately a resolution will see some significant upside to those. So I would argue lower quality companies, more cyclical companies right now in the region are the ones which have trading now close to crisis type valuations, where a resolution will see a very strong returns to risk come back into the markets. And so that's where we're starting to reposition our portfolios a bit more.
Andrew, thank you very much.
Thank you, Emma.
Looking at the US, State Street's Dwight Evans believes the US is a bright spot on the investment horizon, as he explains to Emma about his outlook for the rest of 2018.
Hello, Dwight.
Hello there.
So the first half of the year has been rather marred by negative news, political, geopolitical. Can investors expect a brighter second half to 2018?
Probably not. A lot of the trends that we've seen on politics are going to be ongoing. The trade rhetoric has been in place for quite some time now, and the truth is it's not going to go away anytime soon. What that builds, of course, is an element of uncertainty in terms of how all this plays out from the American side, from the Chinese side, but also there are other countries and other regions involved as well. So difficult to see an end game there anytime soon, and the uncertainty of that is clearly making investors a little bit more defensive at this particular point. So the politics elsewhere, we think of something like the UK, for example, and we think of the midterms coming up in the US as well. That's maybe not having a direct impact on markets, but some of the political trends that have capped some of the enthusiasm at the beginning of the year, I think we're going to see the continuation of that through the second half as well.
Are there any bright spots? Are there any places where you're thinking actually growth is positive and indeed stock markets look positive?
It's still the case that the US looks to be the standout here on a number of metrics. So we're still very bullish on the US dollar. We think that one of the changes in the last 6 to 9 months has been a move towards re-establishing rate differentials as a factor that's driving currencies. And it's very clear that the Fed looks to be on some predetermined path towards monetary tightening. The jobs numbers that came out the other day are sufficiently strong to probably warrant that. There's talk, Canada, the UK, rate hikes. But again, it's at the margins. The US really does look to be in the middle of a hiking cycle. So the dollar looks quite good here. You look at earnings growth in the US as well, and you look at growth potential in the US, it does look to be on a different level, be it short term because of the tax breaks, but it does look to be on a different level to growth trends elsewhere. So again, that probably gives US equities more of a boost than equity markets elsewhere. We actually do recommend at this point being slightly more defensive, but where we do see opportunities is really the US market, and that's probably driven predominantly by what Trump's policies have been over the last 6 to 9 months.
Now, before we began this interview, you mentioned that some people within the company had taken a more defensive stance. And as you reiterate there, that's the sort of thing that you're advocating at the moment. How do investors take that defensive stance? Because traditionally it's been cash and gold, but cash in the past has not looked a very attractive asset class.
No, but it's looking a little bit more attractive now given how yields are moving. So the interesting point about the last few years, and we don't often see this, is that investors have tended to have been very pro-risk in terms of both equities and in terms of bonds. So they've been getting into emerging market bonds, emerging market equities, high yield bonds, etc., etc. In an environment where volatility rises, you have to rethink that strategy. And it's quite clear that investors are rethinking that strategy. So part of what they may be doing is they may be reducing their exposure, particularly to global equities. There may be pockets of opportunities I mentioned in places like the US, but generally investors will be reducing their exposure to equities. The natural safe haven home then is in bonds or in cash. But if they're already extremely exposed to the bond market, cash now becomes an option given where yields are. So I think we will see a shift into cash, a more pronounced shift than we've seen in recent years. And when we see a pickup in cash, it generally shows risk aversion. So I wouldn't think of it in this instance as being necessarily a move towards risk aversion, more towards risk reduction. And that's simply because investors have been very overweight risk markets over the last couple of years.
Good, well, thank you very much.
Thank you.
During times of political uncertainty, should we be holding more cash? Holding too much cash may be a bad idea over the long term, but right now it is a good defensive option, says Andrew Lill, Chief Investment Officer for Morningstar Investment Management.
Hi, Andrew.
Hi, Emma.
So we're here today to talk about cash. It's an asset class that has a bit of a bad rep when it comes to investing because as interest rates are low as they are and inflation as high as it is, or at least rising, cash offers a negative real rate of return. Now that's investing 101, but it doesn't take into consideration market conditions, which suggest, you say, as a contrarian investor, that actually now might be a good time to hold cash.
Well, that's right. Clearly, cash is not an asset that a long-term professional investor wants to have in their portfolio forever. However, cash does have two great advantages going for it. Number one, that liquidity and optionality to invest quickly when markets become dislocated and there is a great opportunity to invest overnight. And two, right now, even though most investors are chasing those returns of the equity markets, in general, the reward that you get for taking investment risk is much lower than it has been for the last decade. Therefore, in that regard, you are better off taking lower risk and getting that reward that you do for cash right now.
It basically all boils down to valuation, doesn't it? And I know Morningstar Investment Management, contrarian, valuation-driven investors. What you're basically saying is equity markets look pretty overvalued and cash might be even a safer place to be.
Well, that's right. So a valuation-based investor focuses on the future rather than the past. Thinks about, what are the asset classes that are going to be able to pay off the best from this day, given the valuations we have today going forward. And we think that actually, particularly in the US, where cash rates are rising quite quickly, they're a much better opportunity right now than investing in US equities, even though for most investors, they think that US equities are the place to be right now. That's what we mean by contrarian, thinking about the future, not the past, and being prepared to be different.
And then I suppose what you're waiting for is for those markets to correct, be it because of a macroeconomic event or a central bank policy, or even just markets overinflating and collapsing, and then you're going to put that cash to work.
Well, that's certainly plan A. But plan B also involves, well, let's say that other markets compared to the US become a lot more attractive, then actually, even though the US doesn't correct, we can put that cash to work in other markets. And we find that while, generally around developed markets, they move in unison, within markets, particularly in sectors, there tends to be quite a large dispersion between the best performing sector and the worst performing sector in any period. And if you're investing in sometimes the worst performing sector, but it has good fundamental strength going forward, it offers the best return. It's actually better to invest in poorer quality investments when they are priced to be very poor than it is to invest in good quality investments when they're priced to be very, very good.
And of course, you're sitting here as a professional investor. People watching this are retail investors. It's easy for you to say, be nimble, have cash ready, invest on the dips, because you're sitting waiting for those dips.
Yeah.
For the individual investor, timing the market, though, is near impossible. Could you argue that it would be better to drip feed over a long period of time on a regular basis so you almost accidentally catch those dips?
That's certainly one way of doing it. And, all we would say is that if you watch the most successful investors over time, the likes of Warren Buffett and others, they tend to be following that mantra of buy when the fear is highest, and effectively sell when things look a lot more kind of comfortable. And so if you start to sell when the market looks very sort of strong and comfortable, you are effectively doing the same thing as a Warren Buffett.
Andrew, thank you very much.
Thank you, Emma.
And that's the end of this edition. We hope you enjoyed this programme. From everyone here at Morningstar UK, thanks for listening.